Welcome and thank you for joining our first commercial seminar in 2025. My name is Jenny Ching. I'm a director and an investment advisor with KW Commercial. A few housekeeping items before we get started. All participants will be muted during the meeting, so please use the chat box for questions and the speaker will answer them during the Q&A session. The session will be recorded and the video will be available on our YouTube channel, WSGBR TV. Our topic today is cost segregation and how it can add value and benefit real estate investors. We all know the standard straight line depreciation is 27.5 years for residential and 39 years for commercial properties. However, you might be able to accelerate the depreciation through cost segregation and receive a lot of tax savings. So today we have invited an expert in this field to present to us all the information you need to know about this topic. And his name is Saul Murray. Since 2019, Saul has been representing CSSI as a national account executive, dedicating his time and expertise to helping building owners unlock potential tax savings. He finds great satisfaction in collaborating with tax professionals, bankers, attorneys, and the real estate professionals to educate them on the advantages of cost segregation. So without further ado, let's give a big welcome to Saul Murray.
Thank you, Jenny. I appreciate it. First of all, thank you so much for having me here. It's certainly a pleasure. I always take these opportunities that I can come in front of you guys, since this is so directly related to what you do every day, and maybe somehow add some value. That's pretty much my goal here. So let's get into what cost segregation is. I know over the last couple of years, it's become more and more common, and people have become more familiar with it. But I used to like to say that it was more like the lesser known cousin of the 1031 exchange, because everybody knows what a 1031 exchange is, but cost segregation. Well, what is cost segregation? Well, like Jenny said, a residential property, multifamily property, as long as it's a long-term residential rental, you're going to depreciate it over 27 and a half years. And a commercial property, that's going to be 39 years. But the issue is that when you buy real estate, not everything that comes with your purchase is real estate. And that's where we come in. Because when you buy a property, everything that's outside that property, so let's say your parking lot, your sidewalks, all your exterior lighting, your drainage, retaining walls, the landscape, all that qualifies as a 15-year asset. So it should depreciate a lot faster than the 39 years. And the same goes for what's inside your property. A lot of the items inside your property, the appliances, countertops, cabinets, certain types of flooring, plumbing, electrical, all that's going to also qualify as a 5-year asset. So imagine you could take those amounts in 5 years instead of 39 years. And at the end of the day, it's the same amount. So why are you going to wait 39 years to take that dollar? With the inflation we have now, that money is just losing its value every day, when you can take it up front and kind of use that now when it benefits you more. And that's kind of where we come in, because in order to do that, you need a cost segregation study. And what a cost segregation study does is we reverse engineer an existing construction, and we identify all the components that make it up. So we're going to break out its roof, its windows and doors, its electrical, its plumbing, and we're going to assign values to all that. And while we do that, we're going to identify the 5 years. Sometimes there's 7 years. Office properties have a lot of 7-year properties. And when we identify all that, the CPA now has this report in his hands. He can take all these deductions that otherwise would not be available. And what that amounts to is sometimes you can take up to 20%, 30% sometimes of the entire value of the property up in the first year. And that's a huge benefit. And if you can use that to offset income, the amount of savings and taxes is just unbelievable. So pretty much you can have a cost segregation study done on a property and sit back 4 or 5 years with the cash flow coming from that property being pretty much tax-free. That's what cost segregation does. So moving on to the next step is kind of what I like to do, which is show you guys examples of what it is, right? Because, okay, so give me some examples, Saul. Well, let's start big here. Let's start with an $8 million self-storage. If they were to do straight line depreciation, they would get about 205,000 for that year. By doing cost segregation, they got 3.36 million in accelerated depreciation. And the cost segregation study for that cost them 11,500, which is a business expense. So these owners were at the highest tax bracket, 37%. And usually I do show most 37% tax bracket. But the way this works is you're going to save money on the taxes that you're going to offset. So if you get $200,000 deduction on your income, that $200,000 times whatever tax bracket you ran, let's say 37%, you would have been saving 75,000 in taxes, which is still great. And that's why it's so great to own real estate, because you get these depreciations. But by doing cost seg, instead of 75,000, they saved over $1.2 million in taxes. A triple net building. A lot of times people ask me, can I do it on a triple net Sol? Well, most likely. Walgreens are great examples. They have amazing parking lots outside. And inside, you do have things that do belong to Walgreens as tenants. They have improved, they have put in, and we cannot claim that. That belongs to Walgreens to depreciate while there are tenants there. But you get a lot of electrical, a lot of plumbing, and the results here show what you would get for a $2.4 million Walgreens. Straight line would get you $61,000 for that year. By doing cost seg, they got almost 10 times that. So instead of $22,000 in tax savings, they had over $204,000 in tax savings by paying a $5,400 fee, which gets them this cost segregation study. And there's other things that stem out of that cost segregation study. It's going to be extremely beneficial for the CPA, but that's not really the purpose here, and I don't want to bore you guys down. Once again, another big property at $17 million, a multifamily. This one at straight line would get a whopping 618,000. But by doing cost seg, they got 4.5 million. And that one also represented some amazing tax savings. But as much as I'm showing you guys these big properties, cost segregation also works on small properties. And that's a misconception a lot of CPAs have. And a lot of times clients miss out on this because even small properties qualify for cost segregation. And this is a great example of a 240,000 Airbnb condominium unit. Via straight line, they get about 8,700. By doing cost seg, they get 27,000. And the fee for that is 2,500. So they saved about $10,000 there by doing that cost segregation. What qualifies? So going back, small property, big property, any investment property, as long as the owner pays taxes, as long as it's in line with the strategy of holding this property, they can do cost segregation. If there's developments, renovations, improvements, cost segregation is an amazing opportunity. There's things that come from that cost segregation report, like I told you, and one of them, it's not stated here, but it's called a partial asset disposition. And basically, you are allowed to expense the roof that you're throwing away when you're doing a roof renovation and replacing it. A lot of times that is thrown away, there's nothing that's lost. And by doing cost segregation, you get your building systems, and we can come in and do what is called a partial asset disposition. But I'll leave that for a further subject and questions afterwards too. I'm always happy to answer questions. When should I not do a cost segregation? That's actually a great question, and I like when people ask me that. Well, it's not always advantageous to do a cost segregation, and some people just can't use those depreciation losses. So every client's going to be different. Every person has their own tax situation. And so the way I like approaching this is we can run estimates on every property since every property qualifies for cost segregation. But once you have that in your hands, you need to discuss with your CPA and see if this is worthwhile, if they have enough depreciation losses, if it's worth using it. If this is a short-term property, if you're planning on flipping properties, you're usually not allowed to claim depreciation. If you can't claim depreciation, you cannot do the cost segregation. Another reason we don't really do cost segregation on properties that you're going to hold for less than a year or a little bit over a year is that you're basically getting a benefit from the cost segregation. And when you sell, you have to give it back via recapture taxes. And now you're out the cost segregation fee that you had to pay to get that study done. Also, if you have a really large increase in income, so sometimes you're not really making much money. in the first couple years you own those properties, but you have money coming in the future, you have sales of those properties and capital gains. So sometimes it's worth holding off on doing that cost segregation, because you do not have to do the cost segregation in the year that you acquire that property. You can do it at any time during ownership. I like to say we can go back 15 years in time, but up until 22, 23 years, there's still enough depreciation left to make this worthwhile pursuing. And usually there's also been improvements to those properties too that have been held a long time. So once again, if you do a $200,000 renovation to the property, cost segregation can come in and give you a benefit just for those improvements alone. And then lastly, if you don't need to do cost segregation, if you like paying taxes. Some people like paying income taxes. They don't want to not pay income taxes, and that's okay too. We see everything in the business that we're in. So like I said, it has to align with your tax strategy. It has to be something that you can use, and we're happy to discuss. We're happy to have conversations with your CPA. We understand that most CPAs do not understand cost segregation 100%. It's not something they do all the time, and that's kind of why we come in. We do a lot of CPEs, which are the continuing professional educations for the CPAs. So it's always our pleasure to get on a phone call or a Zoom and go over that with a tax professional. How can we help your business as brokers? Well, that's kind of what I said when I started here. I want to somehow add some value to you guys. And I've had a lot of experiences with brokers in the past. So something that we've done, and it's helped some fellow brokers, is that if you're looking at potential purchases, you're looking at a couple properties. We have an entire team. All they do is run pre-analysis. They will look at your property that you're looking at, and they will give you an idea of what the benefit from cost segregation will be based on our 50,000 studies that we've completed. Those estimates are free. There's no cost. So I welcome you guys to just bring me property addresses. I'm happy to run estimates there, and it can help sometimes make that decision there. Underwrite the deal sometimes even with the financing. And same goes for listings. If you have listings, investment properties that you're listing, trying to sell, I'm happy to run an estimate on your asking price, and you can share that with your potential clients, potential buyers, people that are interested. You can use it to help market your property. And number three, like I said, sometimes it has helped underwrite deals. Once the banks see all that available cash flow, it's much easier to assume that that loan's going to be able to be paid. So it has helped in the past. I've actually have had specific requests to prepare those. And there's also an idea that you could use it as a seller credit. Say people were haggling over the fee, and I've seen this occur, and that's why I say ask me how. It's a little bit more complicated to explain. So my number will be at the bottom here, and I'm happy to get on a phone call. So feel free to call me. And an exchange fell through. To me, this is where we can really help out sometimes. 1031 exchange. You guys are in the business, you know how those are hard, and sometimes those fall through. And if they fall through, there's really nothing you can do. But as long as the client buys a property in that year, or as long as he owns other properties that he has maybe in his portfolio, we can do a cost segregation study on those. And the losses that we generate there will immediately offset any and all capital gains or recapture taxes that they have on the other assets. So we've done that a lot too, especially with foreigners. Foreigners, they don't have that much of an impact on the income that these properties generate. But once they do sell for capital gains, this is where cost segregation on another asset that they own can come in and really help save the day. Some final notes on these things that I have been saying, because I'd like to go into more of a conversation. And if you have questions, that's kind of what I'm interested in answering. But these studies can be done on any properties, even properties that you've owned, even properties that have been depreciated over the straight line, the 27 and a half, the 39 years. Once we apply the cost segregation, we cannot go back in time and amend the prior return. What happens is that we apply this cost segregation study to the year that you pulled the trigger on it. So a property that you've owned since 2016, we will do the cost segregation in 2024, and you get to take it against your 2024 income. The way it's done is we apply cost segregation as if it had been done on day one, minus whatever was taken out via the straight line depreciation that your CPA usually uses. And we will provide, it's an additional document, it's called a 3115 change of accounting method. and it's just used to correct this information. But yeah, so we can do any properties that have been owned for any amount of years. I like to say let's run estimates on every single property. It doesn't matter the value. The smallest property I've ever done a study on was $67,000. It was a small home in Central Florida, but it made sense to the client and it made sense to the CPA, and we did a cost segregation study on that small property. So we run estimates on everything. Then once you have these in your hand, it's like a roadmap. You can talk to your CPA, you can investigate it further. Some will make more sense than others. Some properties won't make sense at all. If there was a 1031 exchange, that's certainly going to impact some of the results, but you still get some pretty good results. So we can always work around things like that. And it's my pleasure to go over those and have deeper conversations. If a property is a government property, religious, nonprofit, if it's held in IRA, cost segregation obviously cannot help. Cost segregation is there to offset income for income tax purposes, and these entities, and you do not pay income taxes, so there's no point in doing cost segregation. Foreign investors, they're usually taxed in the United States for the income that they have on the assets that they have in the United States. So more certainly it does help them out. It will always be a benefit because it will always offset income that otherwise they would be paying taxes. And lastly, going back to what I had said, if a 1031 falls through, that's where cost segregation comes in. It can help minimize, it can help offset completely any capital gains or recapture that was owed for the property that was sold without that 1031 exchange. A lot of people will ask me immediately, but so I'm kind of scared. I don't want to do it the wrong way. I like doing it the way my CPA does. It's safer. I don't want to get audited, and that's a fantastic concern. Cost segregation is only been around for 20 plus years. Uh, the IRS used to fight this accelerated depreciation that we apply. Big corporations used to impose these, and in 1997, the IRS lost a huge court case to the Hospital Corporations of America. And in result to that sentence, they turned around and they decided that cost segregation was actually the correct method of depreciation. But in order for you to apply a cost segregation, and this is where they came in 2001, they published, the IRS published the auditor's technique and guide for cost segregation. And that's where they impose the rules and regulations and procedures on how to do a proper cost segregation study. And so we abide by the engineering-based studies that the IRS have always asked. We've done over 45, 50,000 studies now, is I think what our number is. We've only had about 20, 22 audits in this past 20 years. We were successful in all of them. So this is a very, very fail-proof audit procedure. And basically cost segregation does not trigger audits. It's not something that's gonna pull attention to somebody's tax return. The IRS, once they get a report from CSSI, who's been around for 20 plus years, they see the 3115 was properly completed. They don't really have any questions. They're not gonna bring our engineers into their offices in order to question. Sometimes we'll get some emails and we'll answer those, but it's pretty much as simple as that. And then again, who is CSSI? So our company has been around for 22 years. We work in all 50 states. We've even completed cost segregation studies on properties outside of the United States, like Puerto Rico, Ireland, Virgin Islands. Sometimes properties that are held outside the United States are depreciated in the United States for United States tax purposes. So that's kind of where we came in. And we do offer some other tax specialty services, but I do focus on cost segregation. That is my main thing. I consider myself pretty knowledgeable, and I'm always happy to answer questions. So, does anybody have any questions?
But I do have a question. So, if we already done it once, can we do it another time? Maybe, 5 years after, if we have additional, say, remodeling or new furnitures or whatsoever?
That's a good question. So what we do is we do the cost segregation on the original building. And your original building now will be accelerated, depreciated, and all that. But 2, 3 years from now, you come in and you do a major renovation. So yes, there will be a benefit to come back in and do another cost segregation. But because you have that original report, sometimes your CPA won't need us anymore. And that's where we're always happy to come in and answer questions and say, hey, your CPA can do it like this or like that because you already have that main frame for the property. But yes, we do come in and do new cost segregations on new improvements, additions, and things like that.
Okay. Great to know.
Somebody needs to be unmuted, Mr. Lee. Let's see.
Mr. Lee, yes. Uh, oh,
Can you hear me?
Yes.
Thank you, Saul. That was very informative. I specifically asked Jenny to invite you. This is good. I have a couple of questions, if you don't mind.
Mhm. Of course.
When you are doing a cost segregation studies as a property owner owning some apartment or shopping centers, what kind of expenses, items, receipt we need to provide? One of the problem most, let's say, investor has is keeping track of records. And when you say that I want to depreciate drywall, electrical, plumbing, those are not capital expenses. And those we may have receipts that I can call back from the vendors or contractor who work on my projects or buildings. But on some other things, you say appliances, equipment, and things like that, you're running on a 5-year study. Tell me what I need to be prepared in case I want to do a cost segregation statistic, item 1, 2, 3, 4, 5.
So the examples I gave were you're acquiring an existing building, and that existing building is coming full of appliances, full of everything. And you don't really have costs for everything. So that's where we
Right.
come in and we break those out. But if you do come in the future and you do improvements, a lot of times you can expense those improvements. You're absolutely correct. Those aren't going to be capitalized, and you get to just write that off. And that's ideally our initial goal. So we're gonna look through cost details if your CPA hasn't done that yet, and we will tell the CPA, well, these we should expense, these won't qualify, we don't need to do this. So an example is I was looking at one today that had about 72,000 in expenses, but only 30,000 is going to be capitalized because the 30,000 was to replace and redo electricity and lighting throughout the hallways. But everything else, all the paint jobs, painting, you get to expense that because that's a repeat and recurring thing you got to do every 10 years. So it's called a routine maintenance, safety harbor. So you get to expense that. And we come in and yes, we want you to expense it all. And once you have that cost segregation study, we give something that is called a building systems. And this is why I said this is going to be a great tool for your CPA moving forward. Because that building system, for example, is going to give a value for the HVAC, a replacement cost. It's completely unrelated with the cost that you use to acquire it. But you're going to get a replacement cost of, let's say, $80,000 for the HVAC system. And then the next year, your HVAC breaks down and you got to replace 2 of the 5 units. And those 2 units, otherwise, most CPAs would capitalize them and then depreciate them. With the cost segregation study that you have, as long as it's less than a third of the replacement costs, which we can usually work it to be, then you get to expense that safely. There's no recapture. There's no tax consequence in the future. So ideally, your first goal is to expense. And then second, you want to accelerate the depreciation. And then if you can't do any of that, then we just conform and take it over 39 or 27 years.
Thank you. Thank you, Saul. I still want to talk to you guys later on. Should I want to do cost segregation?
Yeah, so I
detail.
have, feel free to call, make a meeting. I'm happy to discuss. Our first step is always to run an estimate because there's so much public records out there on these properties. Usually we just need the address. And once we have that address, our team can take a look at it. It takes a couple of days and they'll get back with an idea of what those savings will be.
Okay, thank you.
okay, we have,
There's a written question here.
Yeah.
Mm,
okay, can you see it?
Yes.
Okay, and then, do you want to just,
I can read it.
read it and then, answer the questions?
Perfect. So there's a question here. If a small commercial property already sold and closed last year, previously the property did not do any depreciation deduction, will cost segregation help to file a tax return this year? Not really because of the depreciation recapture. And there's no point in taking the depreciation because it's the IRS, everything they give you all these benefits, they eventually want it back. There's no interest. You give the same exact amount usually back. But so wouldn't be any point in doing it here. But some people have done it because they applied that money into something else and it postponed them another year in order to deal with those taxes. But I would usually not recommend for a commercial property that already sold to do a cost segregation look back in order to save taxes now. But it is possible. It is possible. It is done.
Okay, so there is another question from James. What normal cost for this service?
Perfect. I hadn't seen that one. So the normal cost for the service, the cost is going to depend on the size and the complexity, not really the value of the property. It has to be a flat fee. As part of the IRS requirements, we have to be a third party, independent, unbiased provider. And we have to charge a flat fee that's going to be based on the size and complexity of the property. So our analysts will take a look and it's going to vary slightly. I'd say small condos and residentials and warehouses are going to be anywhere from 2 to 4,000. Bigger multifamilies can range anywhere in the 5 to 8,000. Really big properties are only going to cost maybe in the 20s, 30s. The cost that will be inflated if there's a lot more buildings on the property. So if it's just one building, it's not as expensive as if there are multiple buildings. But if those buildings are all exactly alike, then that makes it a lot easier because we basically just have to do one and replicate them. So multifamilies usually get that benefit. They have several buildings, but those buildings are all the same. But then we do mobile home parks and complex structures that require a lot more reports and math equations from our engineers. So anywhere from 2 to 10,000 is a normal range, size and complexity. Warehouses and small condos, 2 to 3, 4,000. More complicated multi-building properties, 6 to 10,000.
Thank you. Any other questions?
Can I ask another one?
Yes.
Yes.
Okay. I probably missed your number one benefits on cost segregation. You mentioned it's helpful to a potential buyer. Let's say we are broker like Jenny, who is a CCIM. By presenting this, what should we say to the buyer?
So what should you say? That's really up to how you want to approach it. Usually the estimate, once you see an estimate, my estimates are summarized or explained. And once you see an estimate, it makes sense. It's very hard for me to come here and do this presentation. Had I shown you an estimate, it would completely make sense and it makes it easy for you to
Okay.
understand. So I could just run estimates for you, and once you look at that, you could present it to them and say, hey, have you ever done cost segregation? Look at this estimate that I was given. But when you asked about the benefit for you working with buyers, what we usually do is you're looking at multiple properties when trying to decide what to buy, and this one, the cost segregation estimate might say, hey, look at the benefits that are available on a property like this. So, because then you get two things. You get a great property cash flow, and you get that depreciation deduction. So it's almost like a cash back on that purchase.
So you're telling them that they can do the same thing once they acquire your selling properties in years in the future. Is that what you're suggesting?
Yes, yes. So basically, just sharing the information with them and letting them ask their CPA. So that's my goal. And what it does is it triggers their CPA to go out there and study this and learn it. It's nothing out of this world. It's just that most CPAs are tired and they do a very repetitious job of filing taxes every year. So not all CPAs are out there working to save taxes. If you want those, you got to pay for a tax advisor, a higher end consultant. So by them having these estimates, it triggers questions, and sometimes these savings can be amazing. So sometimes we come in as heroes. That's the truth.
Now I see what you're trying to do. So excuse me for interrupting. Because if you
No.
do your cost segregation, then you can say you can tell the potential buyer this will be the tax benefit or depreciation that you can take on an accelerated schedule. So in a sense that if he is more interested in cash flow, I mean, different buyer investor has different objectives. But if he is interested in cash flow for the first couple of years, this will be a quick injection of capital for
Yeah,
benefit.
and it certainly stimulates them to rush and try and close on properties before the
Yeah,
end of the year.
exactly.
Um, I've had
I
many
see your
people
point.
come
Okay,
into me.
got it.
Yeah. By the end of the year, I'm like, so if I close by December 31st, can I still get it? Yes, you can.
Exactly. Okay,
So,
got it. Yeah.
okay.
Okay, good. Now I understand. Thank you. Yeah, I missed your first point. Okay.
No worries. And I'm happy to talk more and share some more insights.
Okay.
Okay, I do have another question. So,
Mhm.
so you mentioned that if the property owner is only going to keep the property for a short term, like a year or a little bit over a year, it's probably not worth it, right? Not worth doing the study. So, is there a breaking point, or how many years you think it will make it worth a while to keep the property?
Yeah. So the good thing about what we do is that these assets that we're accelerating, they are usually assets that lose value. And the best example that I like using are carpets. So when you get that property and we identify, let's say, $18,000 worth of carpet in that building, you're going to get that benefit in the first couple of years of ownership. But 8 years from now, when you sell that, that carpet probably doesn't even exist anymore. It's been thrown away. There won't be any recapture on that particular asset. So it really depends on what you're doing with that cash flow that you're unlocking if you're investing it. Some people will show a net present value. So by me not paying so much in taxes this year, I can use that money to invest somewhere else. And over the course of 10 years, I'm going to make my return much better than if I were to pay taxes now. So it's really that type of calculation where you got to see if it makes sense for you. And even when it's a property that you're going to sell. So you buy a property this year, you do a cost segregation, and next year you get an offer that's just something you can't refuse. Well, you have the opportunity of 1031 that property into something else. By doing that, you shelter that recapture with the capital gain, so there's no issues there. Um, if you don't do that 1031, I explained to you guys, you can do a cost seg and minimize that. So there's options, and there's a lot of other things that go hand in hand with cost segregation. One that I like to mention is the estate planning. So if people have a lot of properties and their plan is to leave it for their heirs, they should certainly do cost segregation, because by doing cost segregation, they take that benefit in life. It can even be taken up until the probate. So the last year, once they pass, they still have to file tax returns, so we can still do a cost seg then. And once the heirs inherit that property, they inherit it at a step up in basis. And we get to do a cost segregation all over again for their heirs. So it's a great estate planning tool also.
Yeah, that's great information. Any other questions? I guess not.
Perfect. Well, certainly a pleasure. I appreciate you all for having me here. Uh, my contact is right there, so please write it down if you ever have any questions. I'm much faster on my email, but feel free to call me directly. And thank you, Jenny. Thank you, everybody. It's certainly a pleasure to be here.
Yep. On behalf of the West San Gabriel Realtors Association, we want to thank you, Saul, for your informative presentation. And like what he said, so if you have any other questions, please feel free to reach out to him directly. And one last thing I want to remind everyone is to check our education classes on the website and register online. Okay, thank you all and have a good one. Bye.
Thank you. Bye-bye.